Hey, welcome back to the channel. Today we're going to be going over Arista Networks, ticker symbol ANET. Over the last 5 years, it's up 154% from the COVID lows. It is up about, 300% or so? Decent amount, yeah. Arista is a network technology provider, network hardware provider. So think like route, switch, spine, leaf, data center fabrics. They actually have a pretty good partnership with Meta, and you can even go on Meta's website to some of their open engineering articles and see their collaborations with Arista. It looks like they've been in collaboration with Arista for probably, I think this earliest article I saw was about 2016, but a lot heavier in 2019 when they helped co-develop a specific kind of data center fabric hardware for them. We can kind of see just how close Meta and Arista have been collaborating over kind of the spine leaf architecture. And Facebook basically has, or Meta has their own OS that goes on top of these. I believe it's called FBBOS. So Arista is providing, from what I can see, the hardware, while Facebook or Meta is basically loading their software on top to run whatever proprietary network like switching operating system they use, which is going to be doing the same like open standard VXLAN architecture. So pretty interesting article here. Kind of get an overview of spine, fabric switch. So it'd be top layer would be spine, middle layer would be leaf, and then bottom layer would be top rack. And basically it's a kind of full 2 or 3 layer mesh topology with a really good amount of redundancy, high amount of bandwidth, which is going to be critical for all of that good old AI compute. And you can even see how this kind of layers into Facebook's engineering plans with some of the AI like supercomputers that they've been building. So typically, the network is going to be obviously the path that all of these supercomputers are using. So it has to be highly available, really, really low latency. And it has to have like the agility to be able to kind of seamlessly fail over to different segments if needed. So this article is pretty interesting. If you want to go into it, you can. Let's jump into their investor deck and kind of just breeze through that. From what I've seen, they have really been pretty much expanding pretty well in the data center segments, specifically with VXLAN spine leaf. But they also have some other networking technologies that they're starting to release, like core routing, SD-WAN, and wireless, I believe. So they have these projects or these products in the pipeline that they're slowly starting to get out. Yeah, they'll tout growth, which they have been growing really well. They've been growing while, I believe, increasing margins, growing bottom line really well. So cloud, universal cloud network, cloud platform. We got AI driven. So kind of their path is right here. So agile and available, leaf spine design patterns, workflow automation across the network, analytics, API driven, configuration and management, having a single point source of truth, testing, real-time data streaming for troubleshooting, things like that, and monitoring, AI-driven detection of failures, and automated like fixes and whatnot. So pretty interesting stuff there. Can't get through a slide deck without seeing AI. So there we go. History here with, I believe this is revenue. Yep. Over the last couple of product cycles. And they're kind of getting into a new product cycle right here, 2022 to 2027. So that's just kind of kicked off. And we have the age of AI and a lot of push behind AI and build outs between Microsoft, Meta over AI, and Microsoft and Meta are 2 of their biggest customers. So they have been kind of competing with Cisco heavily. And from what I can tell, they've been taking pretty decent market share away from Cisco. being in the industry, I can see like a decent amount of advantages that Arista has over some of the Cisco offerings, both from a technological standpoint, a management standpoint, but also a pricing standpoint. So they are probably the first big player, I would say, to really challenge Cisco. Hey, look at that. There we go. Sharing dollars, sharing ports. Yep. So we can see kind of the growth that Arista's had and the decline that Cisco has had. Cisco's still ahead of Arista. So 29.6%, 22.6%. Cisco's at $30 wise, 36.3%, 25.3%. So even though Arista has been kind of taking market share, there's still plenty of market share to take from Cisco, I believe. Adjacent markets, routing in campus, kind of what I was talking about, like core routing, WAN services, edge as a service, software and services, zero trust networks. Okay, there's your security angle. So zero trust networks would be a very big security push on the networking side. So why 9,000 customers choose Arista, modern architecture, innovation, world-class support. Here we can kind of see a breakdown of their products. So cloud and data center, Spine, Leaf, volume, value. So core routing and intensive workloads, specialist applications. So, and I think as a lot of the cloud players grow, and especially if they're doing things specifically for like AI workloads, you're probably going to see more like partnerships and co-developments of specific platforms to really get the most like bang for their buck and kind of target that compute towards specifically the workloads that they need. So I think that is good for the investor presentation. If you want to, I'll have this linked in the description. You can check it out there. But let's go ahead and let's get over into the financials right now. Quickly to the previous 10 years. Let me zoom out a little bit so you guys can see all the charts. And here we go. So we can see we've had really nice bottom line growth for Arista over the last 10 years. Their bottom line yields have pretty much remained pretty consistent. So the free cash flow has deviated recently. But from net income and EBIT yields, they've kind of hovered in that like 3 to 4% range on the valuation, where they briefly went up to, oh man, pretty high. 2019, yeah, I think they had a pullback in 2019. And that's what you have to be really careful with these players, because the data center spend is going to be pretty cyclical. So typically networking hardware and server hardware in general is going to be on like a 5 to 6 year lifespan. So after 5 or 6 years, they're going to be refreshing data centers. So projecting forward, you really have to look at kind of like the area where their customers are in the CapEx cycle, especially the two major players, which are going to be Meta and Microsoft. And then you also have to try to project what type of new business they can drum up. So if they're drumming up enough new business, then a regression in the CapEx cycle of the larger like cloud titans players is going to be less impactful. But most likely, we're going to see this again sometime where they go through a couple quarters where it looks pretty dang bad just because CapEx spend has slowed, and we're going to have a pause before that next CapEx cycle picks up. So that's something to be very cautious of because it is going to be pretty cyclical in nature until they really broaden their revenue streams across a lot more players. So yeah, and you can see that right here, 2019. Yeah, huge drop off in revenue. Had a couple quarters, almost about a year, kind of being flat, and then it took off again. So the thing that I'm kind of worried about right now with this is that it's going to potentially go through the same thing, but well, it will go through the same thing eventually. We just don't know when that's going to be. Like this data center spend super cycle around AI compute. Is it going to last a year, 3 years, 4 years? There's going to be a lot of tailwinds for additional data centers being built. along with the current just refresh cycle. So, and when this does pull back, it can be pretty brutal. And that doesn't go just for ANET, but it goes for pretty much NVIDIA, the chip manufacturers, SMCI, basically anybody that has a lot of revenue that is linked specifically to these data center refreshes or data center builds. So great growth across revenue along with bottom line numbers. EPS diluted, so on a per share basis, they've had great growth as well. See that crazy pullback in 2020. Diluted shares outstanding, pretty flat. Go to the balance sheet and decent amounts of cash on hand. Not a ton of long-term debt or anything, right? So they are pretty lean on the debt and pretty good on the cash and short-term investments, which is nice. A lot of this has been organic growth. It looks like they've probably done a couple acquisitions here and there, but most of it, I believe, is going to be pretty organic growth. Free cash flow statement. Kind of see that chunky operating cash flow here and there. Ratios and metrics. Beautiful, beautiful bottom line margin expansion over the last 10 years. Really, really good. As they've scaled up, their gross margins have kind of remained between 60 to 70%. So they are falling maybe a little bit, but their bottom line margins have expanded really well. So not only, it's great to have a product that people like and use. It's better when you can get these type of margins off of that product. 30% operating margins and 32% net margins is pretty freaking awesome. So let's see per share metrics. We kind of see the general trend of the per share metric growth for operating cash flow and free cash flow. Yeah, so growing 47%, 27%, 30. Then you have a see, we have this really good growth, and then we have a pullback, and then we're having to push up again. So eventually we're going to get this pullback. When is that going to be, though? That is the question. Some small buybacks. I think we did. Yeah, we did have small buybacks. You can see the common stock repurchased, which, yeah, 2022, that was probably a decent time to buy back. I mean, hindsight is 2020, but yeah, that was probably a decently timed buyback. Insider transactions. Got some sales here, but what I really want to see is the insider ownership. All right, so here we can see that we got about 22.96% of shares were held by insiders. And if we go over to the insider roster, we can kind of see, yeah, the CEO owns about, 10.4 million shares. So 10.4 million shares. And what is the 10.4 million of about 315 million? So a couple percent, probably a couple percent. But yeah, still a very healthy chunk of change. 10.4 million times, 160 or whatever it's at right now. Pretty decent amount of insider ownership. But we do see that insiders have been selling lately. Recent insider sells as it's rallied up. So let's go ahead and get into the evaluation on this. Now, oh man, this is an interesting one because it's basically traded at a pretty tight, pretty hefty multiple most of its life. So we're looking at currently net yield is about 3.37, or no, EBIT yield is 3.37, net yield is about 2.89, free cash flow is 1.17. So what I have here is I have a target rate of 15%. Doing net income only. I did net income because our free cash flow is kind of deviated from net income and EBIT for now, and I need to do more research to see what exactly is hampering down that free cash flow. But for now, we're going to look into kind of net income, which is basically right in the middle between free cash flow and EBIT. So dilution, little buybacks. We could probably increase that a little bit. Not really. No, I'm not going to. So buybacks between 0.23% to 0.43%. Bottom line growth. We can see that the 5-year average bottom line growth is 23.97%, but that's kind of offset pretty heavily by the regression in free cash flow, probably due to mostly CapEx spend. But the net income growth is about 32%, and the EBIT growth for the last 5 years about 40%. So doing a 33%, we could do probably a little bit more, maybe. Since we have such a wide variance spread right here, we could do probably 38%. Down to 15%. I feel like that's pretty decent. So we're going off of net income only, 15% targets, and let's see, bottom line fair value yields between 6.05% in the very bearish case and 3.21% in the very bullish case. So, and that's typically, base case is basically right around keeping the same multiple that they have right now of around 4%, 4.5%. So I think that's pretty good. Bottom line income over the base case would then be about 4.6 billion at the end of the 5-year period, which is probably, I would say that's going to be doable if we see these tailwinds continue over the next 5 years. I do think we're going to have long-term tailwinds in this category, specifically in data center expansion, deployments, refreshes. It's going to be never ending, right? It's not like you just build out a data center and you never have to touch it again. You have to basically replace all that equipment every 5 years or so. At least on the network side. So, yeah, and we should have additional builds into the future as kind of compute requirements expand. So off of these assumptions, we have a bearish buy price, or a very bearish buy price at $83. Bearish buy price of 116, base case of 167, bullish 251, very bullish 394. And I could probably put more margin of safety in here. Yeah, that's probably what I would do. Put a little bit more margin of safety, target of 15% with margin of safety 2.5. That would give us a very bearish of 73, 102, 147, 221, 346. So kind of depending on your target KR that you're looking at, that's around what we get. So if we revert it back to the 15%, we can kind of see fair value currently is probably between the, 70 to 130 area, 140 area. And then, 70 to 136. And then 5-year targets under these scenarios would be 168 after 5 years for the very bearish scenario, 234 for the bearish scenario, 337 for the base case, 505 for the bullish case, and 793 for the very bullish case. So that is Arista Networks ANET. Hope you enjoyed it, and we'll talk to you later.